So I'm David Rist from BWD. This is the latest podcast of In the Know, and we have Chris Sellers, Director from Hentons Corporate Finance, with us to talk about different types of exit strategies specifically for IFAs or financial services. So Chris, can you just start off by giving us a bit of background, a bit of your experience?
Yeah, so as you said, Chris Sellers, Hentons Corporate Finance. I head up the advisory team. We support all sorts of businesses nationally on their M&A activities. We're a team of 10 people, a mix of advisors, corporate finance advisors and lawyers, so we manage the whole of transactions.
Okay, so what elements of the transactions are you guys getting involved in? So I'm running my IFA firm, and I've made a decision to exit. What part of the deal are you going to get involved in and help with?
We get involved from day one, and day one could be 3 years before you actually complete a transaction. It's where we'll start to talk about the right strategy, profit improvement, getting the information right, thinking about who the buyer might be. So that could be some years before. We'll work through a marketing strategy if it's an exit to a third party, structure, and then into the legal process. So we've got in-house legal team, so we'll draft all the documentation, deal with due diligence, all the way through to final completion. So it is a one-stop shop solution in terms of from the first moment someone might think about what succession or an exit looks like through to the final completion.
Brilliant. So the typical exit, when somebody gets to the stage where they're thinking about that, is sell the shares or sell the assets of the business, and post-sale, perhaps there's a difference on how long they stay on, whether they want to get to leave immediately. That's not the only option. There are other options, and we wanted to explore those today. When we talked yesterday, I was mentioning the increase of family businesses within financial services where the parent is running the business. They brought a child in at some stage. They've done the right thing and worked through the paraplanning stage and observed how to kind of give financial advice, build relationships, etc. They're now qualified, maybe chartered. And I've had conversations with businesses where it's a difficult subject because their child is still in the business, and how is that child going to be looked after? I'm saying the word child. They're obviously in their late 20s and 30s. Yeah. They're grown-ups. But it's a concern because the owner, the parent, wants their money, but they don't want to effectively sell their child's future to a large private equity company, etc. And we were discussing this and all the different options. So trade sale is one option.
Yep.
What are the other options?
Well, I suppose in the example you're just talking about, and we've seen this not specifically in financial services, but in other industries, where effectively the child actually affects a management buyout of the business. And sometimes we've seen that where it's just the individual, but often we've seen it actually where it's non-family members joining a management team to affect a management buyout. And I think some of the issues that that are raised in terms of a trade sale are often the reason that management buyouts happen, whether there are family members or there aren't family members. It's about looking after the people that have helped you create the business, right, where you might perceive a trade sale that they won't be looked after, or the culture will change, or it won't be right for the people that have helped you build the business. But I think specifically for families, what you get is you get the opportunity for founder to realise some value, but also for the family member, the child, possibly plus other members of a management buyout team, also to realise value in the future. So they'll buy the business, they may pay for it over some time, But ultimately, once they have bought the business, they've got an asset, it has value, and they may realise that at some point in the future.
Okay. So typical option is trade sale, potential management buyout, also potential employee ownership.
Yeah.
So what is that?
Sorry, I think it's relevant because we're seeing an increase in the number of transactions in the employee ownership sector across all sorts of businesses, all sorts of markets, but also in financial services. So that's where a founder sells a majority stake of the business to usually a trust, and the trust is set up to hold the shares for the beneficiaries, and the beneficiaries are all employees. So the business is then owned by all the employee group.
Okay.
So why has that become more popular? The significant tax breaks, and so a sale into employee ownership has a zero rate for capital gains tax, and the changes to CGT Entrepreneurs Relief specifically in 2020 has really made employee ownership more attractive. So tax is one of the things, but I think once you get into the process of thinking about employee ownership, might be the right transaction exit route for a founder. There are other things. It's about maintaining a legacy, maintaining culture, staying involved in a way that you want to stay involved, and there's certainly more control in an employee ownership transaction where you're dealing with people you've known and built a business with, rather than exiting to a third party where it's certainly more unknown.
Mm-hmm. Okay, so let's just slightly focus on the tax element. So the shares are sold to a trust.
Yeah.
Do all employees have to be part of that, or every one of them?
Yes.
So to the benefit of every employee.
Yeah. So the specific test that the trust and any benefits that arise out of it come out of there equitably to all employees. There is some fine tuning around that. If you're a relation of the founder, the exiting shareholder, then there's some restrictions in terms of how you can be involved in the benefits that come out of the trust. But in principle, it's all employees sharing in the benefit of the trust.
Okay. So the company structure, the management structure, is a separate issue.
Absolutely. To
the shareholding, and therefore the decisions are made not by the paraplanner, but by the appointed directors.
Yeah. So often the management structure of the trading company doesn't significantly change. And I think your point is about ownership and management is important. The two things are become unconnected, where historically you've had shareholder who's the MD and therefore they are connected. You've now got a management team that are running the business day to day, but ownership is with the trust, but for the beneficiaries. Now, there are certain requirements of the trust in terms of overseeing the performance of the trading board, but that's not getting involved in day-to-day management.
Are there control issues potentially if you have ownership divided by 10 people and it's equally divided, and 6 of them decide to get together and try and change the direction of the management team, or whatever that might look like? Or is that protected within the trust itself and maybe trustees?
Well, you have trustees. You have trustees that have a responsibility in terms of making the right decisions for the benefit of all employees, not just the half a dozen that have decided that something needs to change. So it is reliant on having the right trustees and also having the right people on the trading company board.
Okay. Tax advantageous because you're selling it into a trust. Equal ownership, let's say between 10 people. When they want to exit, what does that look like? And do you get the same tax advantages, or does tax start to kick in at that stage?
Because it's a trust. There are other forms of employee ownership. You can have direct shareholding, but most of the transactions that have happened over the last couple of years have been sales into trusts. And the reason that is the individuals don't have direct ownership. So you don't have to get involved in buying and selling of shares when someone becomes an employee. Because it's a trust, the trust holds for the beneficiaries, and the beneficiaries are people who are employees at that time. So if you exit, then you stop being a beneficiary, you don't get any value. Certainly one of the reasons that employee ownership has got the support it has is it's seen as a way of both attracting and retaining employees, because you get the benefits of being a beneficiary of the trust while you're an employee.
Okay. Discussing the differences between those options, can we start off with trade sale? Because trade sale in some respects seems more simplistic, but in other respects more complicated, because somebody new is approaching the business and looking at it rather than somebody internally that knows the business. So what are the kind of typical differences between? Are we going to clump the management buyout and employee ownership together in this, or are we still keeping three?
No, I think we can. I think we can pair a trade sale to MBO or employee ownership. But I'll touch on some of the differences there as well. A number of key differences. Trade sale, probably the biggest one, is the amount of money you might get day one, and we all know there are a number of private equity backed consolidators in the market who have the funds to be able to affect transactions, and therefore the amount that they may pay day one compared with an MBO or employee ownership is probably going to be considerably more. So for a exiting founder, understanding how much money they might get day one and how much they might get over a deferred period, that's certainly going to be a choice for them to make in terms of what's right for them. I think the other things are around process. So selling to a third party, there's probably going to be a more rigorous process in terms of due diligence, understanding the business, understanding the numbers, getting under the numbers and all the data that's expected to be available for a trade buyer to come up with the right offer and complete a transaction. And that creates, I suppose, a longer process. So MBO, employee ownership, a transaction could probably be completed more quickly, just because there isn't that level of interrogation in the due diligence process. So that's certainly a key difference. And then probably the next one, and again significant, is what does the world look like post the transaction? So in a trade sale, there's going to be a new management team. There's going to be some new reporting requirements. And what does that look like? And if you've been a founder and managing your own business for many years, that might feel difficult. May not. It may be liberating if all of a sudden you've got finance director and a HR team and a marketing team that you haven't had in the past, and you can lean on those rather than having to wear all those hats yourself. That might be liberating, but it's certainly going to be change.
It's an interesting emotional dynamic, and I think people that sell their business underestimate how they might feel post sale when they can't really do anything about it because the transaction has occurred. But there are a lot of people that have built IFA businesses that have sacrificed family and whatever that might look like, and don't just want to pass that over to a private equity firm that's going to start cutting back certain costs, or even a FTSE 100 firm which will have the same kind of focus. And I guess that's a real big issue to discuss and think about when making those choices, Because the MBO, I guess it's going to continue as it was, more or less, just potentially without your leadership.
Yes, I mean, again, if you've got individuals who are becoming the shareholders, and they may have been board directors before or may not, but there is a point there where they will want to take control. Understanding what that transitional period is from the founder handing over and the MBO team taking full control. Again, that's important. But we've seen a number of transactions where founders have stayed on, and they may stay on in a either as a role as MD or as chairman, or start to step away and take a role as a consultant, just to be there to make sure that their knowledge and their experience and the value that they can add can be leaned on when it needs to be. So again, it's understanding what the exiting founders want and also what they enjoy. But as you said, that's sometimes difficult because all of a sudden you change and maybe it's not what you thought it was. But the understanding what the future is going to look like post transaction is important for the founders to get that clear in their heads.
So the structure of a trade deal is reasonably well trodden. Nowadays, it tends to be private equity. There could be some funding involved, but most of them tend to be private equity. So,
well, I think there's transactions at all levels. You've got the one-man band IFAs who are probably selling out to some of the smaller, maybe a local business that's just bolting on that client base. I think you've then got the next group who are maybe a little larger, but they're selling into some of the groups who are probably debt-backed. They've gone and raised some money from the bank to do some acquisitions, and then you get into the private equity-backed and then the listed companies. So I think there's transactions at all levels, and that makes the market quite interesting at the moment.
So how is an MBO typically funded? How's it structured?
Yeah, so we've recently done some due diligence for a bank that were funding an MBO of an IFA practice, and that's based on what's the profitability, what's its ability to service debt, and on that basis, there's a certain amount of money that the bank are comfortable to lend. So that's day one consideration, with the balance being paid over a period that ensures that the business has working capital, but also delivers a return to the founder as soon as possible. That period of time is obviously driven by valuation, and also growth and profitability of the business. But yeah, day one payment, often from a bank, and then deferred consideration over a period of time.
Okay. Does that deferred period tend to be longer than a trade sale?
Yes.
Okay.
Yeah, but because day one money is going to be less, So and future deferred payments can only be made out of the profitability of the company, where a private equity backed business will have other resources that they could pull on to make deferred payments.
And are MBOs or employee ownership, are they increasing in popularity, or is it reasonably stagnant?
Well, I think the fact that there's such a wall of money out there for to sell into the private equity-backed businesses, I think there'll be more and more of those happening. However, employee ownership we see on the rise, and I think those will be the two, rather than management buyouts. I think those will be the two types of transactions that we see more of over the next few years.
Okay. Any other key differences between the two that people would need to consider?
I don't think so. I think we've covered it.
Okay. So I wanted to touch on kind of the general market, current climate, particularly from a political perspective, because this year I believe that they can somehow stretch it into January for the next general election, but I think it's highly likely that it's going to be October, November time. And also it looks like there's a possibility, certainly the strongest possibility in recent times, that there's going to be a government change, and therefore a potential taxation change. So how do you see that climate affecting the market, and what may or may not happen?
Yeah, we always look at the next budget to think about how might that impact taxation, and therefore our clients who are looking at exiting a business. It's those people that it impacts. The noise from the current Chancellor is that they want to cut taxes. So the budget in March, it feels like it's unlikely to have a negative effect on people who are looking to exit. Although a change of government, October, November, there could be a significant change. Could be a significant change in terms of capital gains tax, affecting any of the types of transaction, including employee ownership. We find it difficult to believe that a Labour government would look to change sales to employee owners significantly, but it may change. So I think what that says for 2024 is we've got ready buyers. So there are people sat with war chests to acquire businesses. We've got a chance of significant change to capital gains tax towards the end of the year. Maybe this should be a year where people are thinking about, is it time to effect a transaction? If it was something they were going to do in the short term or in the medium term, maybe they should be bringing that decision forward just because of where we are.
Okay. I'm interested in your thought process on current kind of valuations of businesses. Consolidation and acquisition seems to have increased year on year on year. And more people have got involved and still getting involved. So I'm still getting contact from brand new entrants that have a war chest. Is it affecting valuations? So 20 years ago, the typical valuation of a smaller firm would be 3 to 4, but typically 3.5 times trail, recurring income, ongoing income, whatever you now want to call it. And if you were larger, it was a multiple of, back then they didn't really call it EBITDA, they called it just profit. Now it's a multiple of EBITDA. Certainly the multiple of the ongoing doesn't seem to have altered a lot, bearing in mind the increased activity and the more people that are wanting to acquire. Just interested in what your thoughts were on
that. I think multiple of profitability has become more relevant because of probably the size of the transactions. You know, those people with war chests are looking. You know, they start off buying businesses and then all of a sudden very quickly realise that it's as challenging to buy a small business as it is often to buy a larger one, and therefore the resources are better applied to buying the larger one. So I think focus on profitability rather than trail. But yeah, the multiples have definitely gone north, you know. And I'm trying to remember a conversation I had with someone recently, but certainly, you know, 6 to 10, depending on where you are in terms of size and complexity of business, you know, those are the kind of ranges that have been paid in recent transactions. And I don't see that going backwards in 2024, again, just because of the desire of the consolidators to add more volume.
Have you seen a change in deals falling over at some stage with there being more players in the market? So I came across a scenario the other day where a typical trade purchase is going to be around about 50% to 60% up front. and then the rest divided between either 2 or 3 years. This one particular acquirer was offering 80% upfront, and then the rest over the next couple of years. So that suddenly becomes attractive because it takes a bit of the risk out whether the seller gets the rest of the money. However, the discussions I was having was that the 80% really is to get the initial interest. You're then invested in that whole process of a very painful due diligence.
Yeah.
You know, that selling your business isn't easy, and there are some very difficult conversations that go on, and the amount of information you have to find has an impact on typically has an impact on the trading of the business. So you've gone through all of that, and then there's some kind of renegotiation because of the information, and a lot of those I've seen have fallen over because the trust has suddenly gone, and they've had to start from scratch. So I'm just wondering whether you've seen an increase of that, or whether that is as it always has been.
So I haven't seen an increase, but just thinking about the marketplace, you can understand why. If you're selling your business and you've had half a dozen people come through the door, all make you an offer, and they may have different characteristics, and you may have the one that's going to pay you 8% day one. The problem is, as soon as that deal starts to waver in any way, or the trust starts to diminish, you've got the other 5 people to go and talk to who came through your door and made you an offer. So I think that's the challenge. So if purchasers are disingenuous in their initial offer, with the expectation that they can then in some way change or chip away that offer, they've got to be realistic that that they're not the only option. There are other options, and I think once you've lost that trust, it's really difficult because you're going to be working together for a number of years, and so I think people will step away. So I think purchasers need to be very cautious of, trying to get ahead of the competition by putting something forward that actually they don't believe in or aren't going to deliver.
Okay. Brilliant. I've run through all my questions that I had for different exiting strategies for IFA firms. I think we've talked about areas that aren't particularly well known, particularly the employee ownership.
Yeah.
I think was good to discuss because I think that will be of interest to people, certainly just to take it into consideration. And understanding more of the pros and cons about MBOs compared to trade sales, I think is going to help a lot of people. So thank you very much for taking the time out to talking to us.
Thank you.
Thank
really
you.
Enjoyed it.